You are listening to the Blockchain Dialogues podcast. All views expressed on this show are for educational purposes only and not meant to be taken as financial advice.
Hello and welcome to another episode of the Blockchain Dialogues podcast with your hosts Krishna and Nikhil. In this podcast series, we analyze various cutting-edge technologies and projects in the field of blockchains, DLTs, and cryptocurrencies. In today's episode, we're going to be discussing a DeFi protocol that is aiming to engage all crypto assets, including altcoins with smaller market caps, into the DeFi economy. We're talking about a new lending protocol called Fringe Finance. The protocol looks to enable crypto projects and institutional investors to earn interest on deposits while allowing holders of smaller market cap altcoins to use them as collateral. To discuss the project in detail, we are joined from Sydney, Australia by Brian Pasfield, who is the CTO at Fringe Finance. Brian, a very warm welcome to you on our show from Nikhil and myself.
Hey, it's great to be here. Thank you for having me.
Welcome, Brian.
So to begin, could you tell us a little bit about yourself, your background, what got you into blockchain and crypto, and your journey so far?
Yes, okay. Well, as quickly as I can. My background is engineering, so I love technology. I've had a lot to do with software development and delivery over the years with the consulting background, software engineering, working for corporates and banks and government. And I had quite a lot of exposure in the finance space. And, you know, a few things back in the day, I smelt a fish. And because, you know, there's so many things that are cooked like CPI and the fact that there's inflation and so forth. And there are just so many aspects of it. And I thought, it'd be great if there was a really fair way that this all worked out and there wasn't a monopoly on money and so forth. Anyhow, a number of years down the track, I began becoming involved in commodities trading, gold and silver and energy, and looking at the macro trends globally and beginning to understand a little bit about how things stitch together and develop quite a bit of interest in that, worked in the space. And then along came Bitcoin. And a friend of mine said, Brian, you just need to look into Bitcoin. And in about 2013, he said, just go out and buy several $1,000s worth of Bitcoin because this is the way of the future. And we had quite a similar philosophical background. And so we understood what theoretically it could portend for the world. And I kicked myself because it was about a year before I took any action on his advice. But so I've been involved quite early on. I've been involved in lobbying for legislation here in Australia. So there's some policy and legislation that has been formed around some of the work that I've done there. And I've been, as much as possible, active in the community, working with various projects, Bitcoin point of sale systems, merchant systems, trading systems, trading bots, voting systems, and quite a variety and a range of applications and solutions in the crypto space. And meanwhile, my career in the consulting space was progressing, and I was working as CTO for various startup organizations. Even though I had a large shop background, I was very interested in the smaller and more dynamic spaces. And so ultimately that has led to me being the CTO for Fringe Finance. And that's been quite a ride. And we're just at a point where we're about to release our first product to market. And it's definitely been a really good intersection of my technology background, my awareness of finance, involvement in that space, as well as my philosophies and views on, I think, what can be, identifying that there are things that definitely could have been improved in that space. So really, it's a really good intersection of a lot of my interests and expertise, I think, in that space, or at least experiences.
Okay, so before we go into the details of Fringe Finance, about the company and how it works, I just wanted to set the perspective for our audience. In the last couple of years, DeFi has been the main growth engine for crypto as a whole, and there's been many different kinds of financial services built in the DeFi space. Everything from lending platforms to decentralized exchanges to services focusing on synthetic derivatives and many other things, right?
Correct.
So, Brian, for our audience, could you give a very brief 2 to 3 line description of where Fringe Finance fits within the DeFi industry and the problem that it is going after?
Yes, Fringe Finance is, in essence, a lending and borrowing platform. There are a number of lending and borrowing platforms already in the DeFi ecosystem, but Fringe Finance has a very particular focus, and it's looking to specialize in the space to support using a whole range of altcoin collateral or altcoins as collateral for borrowers to take out loans. So that is really our focus, which is slightly different to a lot of the other lending platforms that are quite popular in the DeFi ecosystem, where those other lending platforms tend to focus on the larger cap, the larger coins, and the more popular coins in that space. We're unlocking the value that is in these altcoins. So these altcoin holders who are passionate about the projects can retain exposure to the upside of their coins and deploy it as collateral to take out loans, and then use that to deploy elsewhere in the DeFi ecosystem.
Great. So basically, from what you described, the key differentiator is that it's a lending platform that's geared towards people who are holders of these low cap altcoins versus the general bigger ones like BTC, Ethereum, and all the other big ones, right?
Correct. Yes.
So just to take a closer look at how Fringe Finance, the system works. First, you have the lenders. Lenders are generally large institutions or other entities that are willing to lend out USD holdings in the form of USD-pegged stablecoins. And then, as usual, you have the borrowers, who are generally individuals who have these low-cap altcoins with them that they'd like to put as collateral so as to take a loan from the system. And then you have liquidators. They are the people who liquidate positions when they fall below the minimum collateralization levels. And for all of this to work, you also have your own stablecoin called USB stablecoin, which is pegged to the US dollar. And then you have the FRIN token, which I guess is used for the voting mechanism in the DAO that you have in your ecosystem. So Brian, looks like there are many different moving parts to the system. Could you explain for our audience how all of this works?
Yes. Okay. I'll initially focus on the lending and the borrowing side of things. So as you quite rightly mentioned, institutional lenders can deploy their US dollar holdings that earn very little interest in traditional banking system. They can deploy their US dollar holdings by swapping them to stable coins and then lending them out on our platform to earn far more attractive interest rates. And that suits institutions and any other US dollar holders. So we see that as a continuing and a growing market, and we want to really support that. On the borrower side, as again you quite rightly mentioned, borrowers who are holding the smaller cap altcoins can deploy those onto our platform to take out loans. Now, there are two personas, really. The first persona is the passionate altcoin project holders who wish to deploy their capital because there are very few opportunities elsewhere in the DeFi ecosystem for them to deploy their capital to take out loans. And they're more typically the individual holders. There's also the projects themselves that hold large treasuries in their native token, or at least their project token. Now, the Fringe Finance platform allows those projects to deploy their treasury so that they can take out stablecoin loans to reinvest into their project or to spend on operational items to keep their projects running. So this is a real great opportunity for them, and we're partnering with quite a number of projects in that space, and we look to see more over time.
So just to clarify, this is like looking at it from the perspective of a new project, which is really low in market cap, let's say. They would be looking at deploying their treasury on this platform versus spending it on marketing and airdrops and stuff that they would generally do, I would say.
Yes.
Just a couple of things that I was trying to look at over here or kind of think about over here is, and one is basically if you're looking at, say, a new project coming on, right? How do you actually know what price that particular token should be valued at? Is there some kind of evaluation that is done on that particular borrower? And in case if that is, then how does that work?
Okay, yeah, I'll give you a bit of a view on that. We do undertake due diligence, if you like, on the projects that are looking to list on our platform. And that really has a lot to do with, we like to know who the project is, who the individuals are, if they are doxed, if they've let themselves be known, or if they have not let themselves be known, we like to see if they have other projects under their belt, so that they're good actors. And we look at a number of factors. Is the project decentralized sufficiently so that it avoids the opportunity for rug pulls by centralized entities within the project? And so they're the qualitative aspects, or some of the qualitative aspects that we look at, but there are also quantitative aspects that we consider in listing a coin. And that largely has to do with the market volatility, a historic market volatility for those coins, and also the available liquidity for those coins. Because as you mentioned earlier in this discussion, they're one of the key actors for maintaining stability of the platform as the liquidators for any of the borrowers who allow their positions to become lower than the minimum collateralization level. Now, those liquidators, for themselves to perform the very crucial function that they perform on any lending platform, will need a mechanism to dispose of the assets that they win in a liquidation event. And we can talk a bit more about that later, but essentially they win the collateral, or a sufficient amount of the collateral to reward them for the effort that they're undertaking. And as a consequence of that, any rational liquidator is expected to dispose of that collateral asset on the open market for more popular stablecoins or other higher cap coins. And for them to undertake that disposal, they need to ensure, or there needs to be sufficient liquidity in the marketplace to allow them to perform that action without affecting the market too much, without the liquidators experiencing too higher slippage. So that is one of the key factors that we consider, which is the market liquidity for these tokens on the various exchanges, be it centralized exchanges or decentralized exchanges. And that goes into determining the parameters that we define for the lending that we offer against any given token. The market volatility affects the loan-to-value ratios that we're willing to offer. And that historically tells us the kind of fluctuations that could occur during a period of time during which liquidations could be expected to be performed. And therefore, that protects the platform from becoming under-collateralized. And the market liquidity affects another parameter that we define for lending, which is the maximum aggregate available borrowing against any given altcoin. So these are some of them are standard engineering aspects of lending platforms, but we have engineered some special engineering aspects, particularly around the maximum borrowing capacity. given the liquidity of some of the altcoins that we're looking to support, is not going to be as large as some of the more popular coins out in the DeFi ecosystem. So we need to contain that to ensure that our platform can remain stable.
Right. So to push back a little bit on that also, so you had mentioned that you look at the qualitative aspects of a particular project and you look at, the historical market volatility and stuff. But if, on the other hand, if you are a new project, which is typically what a lot of altcoins are, they're new into the market, you may not have that history to qualify, to do that kind of evaluation. So are you saying that, hey, okay, if I am a new new coin coming onto the market, this particular platform is not a viable option?
A coin does need to have, or a token does need to have some history for us to be able to successfully or meaningfully assess it. Theoretically, we could still list a very, very nascent token, but it just means those parameters would be quite constrained. For example, with a very new token, it might be expected that there would be very little trading liquidity of that token. And so that would quite meaningfully restrict the amount of borrowing that we could offer against a token like that. We will continue, for any token that we do list, we continually reassess the available liquidity in the marketplace for that token so that we adjust our parameters ongoing. And when it comes to market volatility, you're quite right. Early in a project's or a token's life, it's quite usual for there to be high volatility on that token. And so that will reduce the loan to value ratios that we would be able to offer for those tokens. So theoretically, it's quite possible, even for a very, very new token, for us to list, but the commercial opportunity in listing that token in such an early stage of its lifetime may not warrant the costs for us to incorporate it and integrate it into our platform. So ideally, there is a little bit of history or sufficient history for us to be able to undertake that. We can look at various partnerships with projects to help offset the costs associated with that. But what we would like to do in most instances is merely list the token if it has sufficient history to us to be able to list it in a profitable manner.
Yeah, so I actually had a chance to read through some of the stuff in your white paper, and so I guess you use a mix of different criteria to give risk ratings to these various low cap altcoins, and like you mentioned, the history of price volatility combined with the amount of non-circulating supply that exists in that project, and other factors as well, right? And this is basically what decides the loan to value ratio of that specific altcoin. Could you touch a little bit on like what is the mechanism to revise this on a timely basis, or does the community play a part in this? Is there any sort of voting for at least qualitatively looking at the risk rating for an altcoin?
We've got quite a bit of automation that we've built that assesses the marketplace and assesses the metrics that feed into these parameters. So it's really a matter of rerunning our automation to pop out updated and revised figures. The marketplace or our community, they would be very interested in ensuring that the platform remains stable. So what we're initially doing is using our automation to derive a set of parameters, and we're applying a conservative factor to them. And as the platform and the token proves itself, we will be relaxing some of those conservative parameters or conservative factors so that we can see how the market behaves and how that token behaves on our platform. As I mentioned, we've got some special engineering that we employ to just to best support this paradigm of supporting these smaller tokens. So we're quite passionate about that because there is tens of billions of dollars locked up in these small tokens that otherwise could not be deployed into the marketplace. And we think we have the right approach that allows these token holders to now deploy their capital into the marketplace.
So when you say automation, I'm a little curious as to what kind of automation are you talking about? Does this come some kind of data analysis? If so, where is the data coming from?
Yes. Okay. So two of the key aspects there is we look at order books, and there are some aggregated order books that we use that approximate or that represent a segment of the market, and we extrapolate that over the entire market, and so that we can understand what the slippage is for any particular price movement. And we also have automation that looks at price history to determine the volatility of these tokens. And we're just about to release a Medium post that describes this in greater detail on our current website, which is fringe.fi. Fringe.fi. So that automation really looks at those two key aspects and collects that information in an automated sense from the available data sources.
Okay, cool. And so again, from the decentralization aspect, so are you looking at multiple data sources, or are you looking at just one? Is there a way to kind of hedge your risk when it comes to the data source itself?
That's a really good point. Well, price data or price history, I don't think there's too much risk of a single data source being an issue there, because it's price history, and if there's any anomalies there, they tend to wash out. Because we're taking averages and looking at worst case scenarios. We look at outlying situations there, and we top and tail that data to remove anomalies. On the order book side of things, that data is already aggregated, and we use various platforms such as Binance and so forth, where a lot of these tokens are listed. And as and when new sources of information come into play, we can incorporate that into our automation. But that's a very good point.
Very interesting. Thank you.
Yeah, I was just taking a look at your website earlier, and I must say that you have a pretty impressive list of partners right now. And I saw this Chainlink on there, and I'm guessing Chainlink is being used for price feeds. And you have Polygon and Bancor. Could you speak a little bit about some of the major partnerships that you have currently?
Yeah, briefly. You're quite right. There are partnerships which are have multiple aspects to it. For example, as you mentioned, Chainlink is both a token that we're listing on the platform to provide holders of the Link token to take out stablecoin loans, as well as currently we do employ Chainlink data feeds. And data feeds is quite important for a lending platform. And with the criteria that Chainlink apply to listing or providing price feeds for a given token, that satisfies the need that we have for a multi-sourced and, if you like, a tempered price feed that attempts to remove the opportunity for price manipulation and price manipulation attacks that can occur for various single point data feeds. That is quite problematic for lending platforms. So definitely Chainlink is, there's multiple aspects to the partnership we have with them. And we're also assessing other price feeds because over time there will be various appropriate technology that we can use to ensure that we get sound price feeds. But with a lot of the other projects there, almost all of them are definitely listing opportunities where we will be listing their token on our platform, as well as other technologies that we look to incorporate as part of our roadmap. Our roadmap includes a number of things. And this is probably a good transition to just talk about our roadmap a little bit, because it includes not only the variable interest rate lending facilities that we'll be offering initially with the release of our platform, but will include things such as fixed rate lending, cross-chain integration, and insurance. So lenders can insure their positions. And some of our partners there offer capabilities in that space, and we're looking to integrate and leverage their project's capability to support part of our roadmap.
Just to move to another kind of a topic that is part of your platform, and that is basically the stablecoin that you guys are using, right? You have a stablecoin called USB, and I was just wondering, so what is the role that USB plays here? Is that the primary asset that is used for allocating and lending out to people, or are other stable coins also a part of it? You can list other stable coins also and use those.
Our product suite, our platform includes two major components. The first component is the primary lending platform, which will lend out popular stable coins such as USDC, for example. A next release currently under development will be our stablecoin platform, and that will incorporate our stablecoin. So one can think there of a model that is similar to the DAI, the MakerDAO stablecoin platform.
Right.
And the purpose of that is to, ultimately, the purpose of this project is to fulfill the agreement that we have with the initial governance token holders who purchased our governance token during the initial coin offering. And that contract, if you like, is to develop a system, build a system that is useful and desired in the DeFi ecosystem for the benefit of, or for the benefit and the return for our governance token holders. And our governance token is the Fringe token, FRIN,
yes,
as the Fringe token, and they will receive a proportion of the fees collected by the platform. So with the stablecoin platform that we are currently under development with and releasing after our initial primary lending platform, we anticipate with the investors that we have with the stablecoin platform that we're building, the ability to create good liquidity in the marketplace for this, and therefore create appropriate demand for this stablecoin. And that will increase the adoption and the scalability opportunities for the Fringe finance platform. So ultimately, it means more utility for the DeFi ecosystem and ultimately greater return for the Fringe governance token holders.
Right. So the USB token is going to be there in the same list or the same pool and be kind of used mainly as a way to reward your Fringe stakers and the initial participants in the project.
Just to piggyback on that really quick, Brian, could you also explain the role of the Fringe stakers in the ecosystem?
Yes, the Fringe stakers are governance token holders. So currently the project is run by the project team, but we are moving to a DAO model whereby the Fringe governance token holders will vote on DAO proposals for further evolution and refinement of the platform. So they will define the direction of the platform so that it ultimately achieves the adoption targets and scalability that is ideal for the platform. And the governance token holders will have an awareness, we anticipate and imagine they'll have an awareness of the direction and be able to make proposals for the greater benefit of the platform. So that's really their task. owners of the platform, or at least they have the ability through the governance token holdings of theirs to make decisions for the direction of the platform.
Right. So these are not like, so what are these decisions like? Obviously, they're not something like determining the risk level or determining the price of tokens or anything like that. That's mostly automated. What typically would they be governing? Would it be kind of more like software updates? Are we talking about that?
Well, it will be a whole range of things, but just going back to the automation that you refer to there for determining the parameters on the system, governance token holders do have the ability to refine or propose refinements to the models and the automation that we use currently to determine the parameters of the platform. So in a real sense, even though there is automation there, they can propose modifications to those. And those modifications can be assessed against the prior performance of the automation that's currently in place. So where there's opportunities to improve that, or when market dynamics change in such a manner that warrant a review of that automation and the models that are employed there, then the DAO and the governance token holders have full say in the way that that will evolve. So that's just on the automation for determining those parameters, but also they will have the decision-making capability on the precedence of roadmap items and the adjustments to the platform over time, because there's always opportunity to add functional capability to the platform. And there is a cost benefit that is always valid in weighing up and prioritizing any new enhancement to the platform. And the Fringe governance token holders will be instrumental or be the decision makers in that process. Also, the marketplace we anticipate will change in ways that are just impossible at this point to really foretell. And so the governance token holders, having skin in the game and visibility of the DeFi marketplace, will be able to determine what the needs are in the marketplace and propose new functional capabilities and or roadmap items to ensure that the platform forever remains relevant.
Cool. So that makes the Fringe stakers role clear. There's another actually group of people in the system, which are the liquidators, right? So what is the incentive for a person to become a liquidator? How does that kind of work? What does one need to do to become a liquidator?
The incentive for a liquidator is they receive a reward for performing a liquidation. With most, if not all, lending platforms in the DeFi space, there is an over-collateralization requirement, which means when a borrower takes out a loan, they are staking a greater value in collateral, so that as the market price of collateral changes over time, there's always sufficient collateral backing up the loan that they take out. Now, we have thresholds which trigger a liquidation, which is still above the point of the platform being solvent or that position being solvent. And at that point, what occurs is the liquidator pays back the loan so that the lending pool is made whole. And the collateral that is being staked by the borrower is returned to the borrower except for the amount that the liquidator pays back to pay back the loan, plus a liquidator reward, which will be in the range of, say, 6.5%. It depends on the token, and depends on the slippage ultimately of the token on the marketplace, to ensure that the liquidator receives sufficient reward to warrant them deploying their capital for the purposes of liquidations rather than any other use case that they could deploy their capital for. So that liquidator reward is really the prime driver in motivating liquidators. So the platform employs incentive-compatible mechanics in the game theory to ensure that the various actors are sufficiently incentivized to perform their role in maintaining the stability and or using the platform.
Would there be an advantage, if instead of having this role being played by the liquidators, the same thing is handled by smart contracts, where if it falls below a certain threshold, the position gets liquidated, is that something that wouldn't fit in this approach?
There's various ways that could be achieved. The way we like to look at this, again, just going back to the game theory around this, is to create incentives for actors so that they perform in a way that balances the system. There's other factors that come into play, which is there is a penalty to the borrower when a liquidation is performed. And it is a much better approach for that to be performed by an interested but otherwise impartial actor, being the liquidator, and incentivizing them, rather than the platform themselves performing a liquidation and penalizing the borrower. It just keeps the platform itself as being quite objective, rather than it going about and penalizing borrowers. They're performed, or these functions, and if you like, the cost is performed by interested actors.
Makes sense.
Yeah. But having said that, over time, if there are appropriate automated models to consider, well, then the Fringe token governance token holders can assess this and over time may begin to employ that.
Right. Almost like an automated liquidator function. So one other question, in the whole thing, so you mentioned penalties, and obviously there is the rewards that you're giving to the liquidator. Is there any other type of fees that the borrower or the lender have to consider when they actually interact with the platform?
Yes. So most interactions with the platform incur a very small fee of 0.25%. So that goes into our treasury, and it funds the continual development of the project as well as rewarding the Fringe governance token holders or stakers of the Fringe tokens. I think it's probably worthwhile me also mentioning that though there are quite potentially opportunities for automating some of those functions, such as the liquidation, as was mentioned a couple of moments ago, liquidators specialize in performing liquidations, and they have their own disposal paths, their disposal strategies that allow them to specialize and compete with one another. So that competition ensures that if we automated things, or if the platform automated things, there will be whatever disposal strategies or efficiency in what could be automated there. But leaving it to the marketplace ensures that the appropriate competition plays out and liquidators devise the best and most effective way to perform liquidations.
Okay. Speaking of fees, again, obviously you mentioned your admin fee, and there's obviously the money that goes to the stakers and the liquidators, etc. This is also over on top of the fees that are just the gas fees of doing these transactions, correct?
Correct.
So I was just wondering, given that we currently kind of always been getting a lot of in the news. It's always the gas fees are so high, and there's always this particular story about how difficult it is to do anything on the Ethereum blockchain. I was just wondering what your perspective on that is. Do you have any plans to address that particular thing and how that might affect the functioning of the platform as a whole?
Yeah, it's a wide-ranging set of considerations there. I mean, gas. It's quite interesting. One could be subjective in their view of the cost of gas fees, but looking at objectively, they are what they are because there is the demand for it. And the reason there is the demand for it is because it has value to the participants who interact with in this case, the Ethereum blockchain to perform whatever actions they do on that blockchain, including participate in the DeFi ecosystem. There are other layer 1 chains, and there are also layer 2 chains that look to alleviate some of those, but they come with trade-offs. Ethereum platform is proven that it's the most secure, and therefore the utility that provides, an assurance that it provides participants on that platform is obviously of value to them. Hence the price associated with performing actions on the Ethereum blockchain. With other layer 1 platforms, well, that race is still underway, and it's really yet to see if in the long term the security and the utility of those platforms will play out. For certain use cases, it has a lot of utility. But because of some of the more centralized aspects of those layer 1 platforms, it represents vulnerabilities and threat attack vectors that certain participants, particularly the ones who like to remain on the Ethereum blockchain, don't wish to entertain. So there is a place for all of these platforms. And as layer 2 platforms or capabilities for the Ethereum blockchain come further or mature further, there will be opportunities for Fringe finance to employ those. And again, that race is being played out also. And the governance token holders, our DAO, will make the appropriate decisions at the appropriate points in time to adopt and employ those layer 2 capabilities or bridge to other layer 1 platforms, or even to spin up a separate instance of the Fringe finance platform on other layer 1 blockchains. So these are all open for consideration, and some of those considerations are within our roadmap, but jostling around with best value for market adoption, for achieving market adoption for the Fringe finance platform. So yes, my view is that there is great value in what is considered the high cost of gas fees on Ethereum, because the market finds great utility in that.
Right. So what do you think about the efforts to move away from or to put in place mechanisms like, the Ethereum 2.0 move and all of those that hopefully would reduce the technical limitations of the transaction speed and things like that? Do you think that has a material effect, or is that just something that happens and is not going to affect the cost of gas fees?
That's such a wide-ranging. There are such a wide-ranging set of considerations there.
Yeah.
In short, I would say this: there's certainly mechanisms that will increase throughput on the Ethereum blockchain. However, that demand will be met by people or actors who wish to employ that additional throughput. So it will be a continual game, and gas fees will remain high. But there are also other aspects of Ethereum 2.0, which is a movement away from more decentralized mechanisms to a more centralized proof of stake mechanism. And there will be, and that opens vulnerabilities for the platform, which I think will be very interesting to see how it plays out in the marketplace. I don't want to suggest that there will be a contingent of Ethereum actors who wish to retain the proof of stake, the proof of work consensus mechanism or the proof of work model. But that may very well be the case, that there could be a retention into the future of a proof of work platform also.
Yeah, I believe it is planned as a hard fork, correct? So there should be the proof of work chain, but I think the main thing over there is that they're expecting, or they're going to try and put some mechanisms in place to make it very, very hard to use that particular fork. And yeah, you said there may be some contention about putting that mechanism in place and just accepting that it's just another fork and you have two types of Ethereum. That is in fact an interesting thing to consider.
Yeah, let's see how it plays out.
So Brian, we've had a pretty wide-ranging conversation, kind of covered quite a bit of, I would like to think we covered quite a bit of the Fringe Finance platform, and from a more functional and technical side. Can you think of a question that we have not asked that you would have liked to expound upon?
I think it's interesting to consider where the whole landscape moves to in time. I think in the first instance, this notion of let's just call it Bitcoin or the value transfer capability, that was the key game changer. So there is a money that is not a monopoly money, or it's not monopolized, and it's got all the attributes and qualities that it has, which allows transfer of value. And that also is employed by Ethereum and really any token there sitting on the Ethereum blockchain. And now in the DeFi ecosystem, we've got a layer of services on top of that ability to transfer value. And, you know, as we can see, and as we are players in that space, there is more and more facility, as you mentioned at the early part of this conversation, with lending platforms and derivatives and options and trading platforms and insurance, etc., etc. And all of those services will continue to evolve. And where things go from here, I see a key missing piece is now that we've got the value transfer capability in place, and then what was built on top of that being a set of services and applications and platforms that employ that ability to transfer value, we now have entities emerging in that space, in the decentralized space, which are entities in their own right, which don't exist in any state-based jurisdiction. And they, at the moment, don't have a well-developed ability to resolve disputes between themselves. As more and more of these DAOs come into existence and more of the community begins to work for DAOs, there will be the need for contracts to be made between these DAO entities. And because they are, by and large, not recognized in any state-based jurisdiction or state-based legal systems, at the moment there is no real effective way to arbitrate disputes between them, or at least to have veracity to the verdicts made by any dispute resolution process. And the way I see this panning out is a number of facilities coming into play to enable this. And this is part of a project that we are working on. And this is the ability for reputation to be the basis of ensuring that verdicts made when resolving disputes between various parties to a contract, that their reputation is at stake. Because in state-based legal systems, the veracity of a verdict ultimately boils down to the ability of the state to employ force to uphold that verdict. Now, that ability to uphold force does not exist in the decentralized, distributed, ethereal world of DAOs that don't exist in any state-based legal framework. So what will be at stake is their reputation. And this reputation will give other actors and people wishing to interact with them and contract with them good visibility as to whether they're good actors. And if they are not good actors, for example, if their reputation tells the marketplace that they either don't uphold the terms and conditions of contracts, or even more to the point, don't uphold the verdicts of any disputes that are raised or that they're a party to, then this will severely inhibit their ability to continue to interact, because people will be reticent to enter into contracts of any greater and greater value. And as this ecosystem extends and expands and more of the, if you like, energy of the world moves to operating in this decentralized space, it will be quite crucial for the greater value of the contracts that will be struck between the various parties in the system. And those parties can be both DAOs and any other individuals, even through their pseudonymous identities. It will be necessary to have a dispute resolution process that has veracity, and that veracity will primarily be dependent on reputation. So I see that being something that will come to the fore, and certainly watch this space for things that we've got in the concept stage at this point.
Awesome. Thank you for that sneak peek.
Yes.
Just my thought on that was that, like you pointed out, reputation is, almost as strong as reputation, that it is the identity tied to it that would matter, right? Because if you, it is possible for people to assume different personas, different identities, and then cultivate them separately. So unless you have a very strong way of tying that reputation to what people trust is as a strong identity, that would be a key piece of that effort, of any effort that kind of looks at using reputation as a social signal or even a dispute resolution signal.
Yes, it's interesting, that term that you used there, what was it, strong identity, will and should always be pseudonymous. Reputation is very domain specific. For example, if I have a good reputation in the beekeeping community as someone who can help establish healthy beehives, that doesn't account for much if I'm seeking finance. So it's quite domain specific, any reputation. So it won't matter if there are different pseudonymous identities.
Well, I'd like to kind of push back on that, right? So in the sense that if I had a reputation in a beekeeping community and I applied for finance on a project that involved beekeeping, then obviously that reputation would be a strong signal to the financiers that, hey, I know what I'm doing, so you should lend me some money.
Okay, definitely, I give you that point. Yes, I think if there is the ability to merge, voluntarily merge identities to help and reputations associated with them to help undertake further interactions with actors, that definitely has its place. Yes.
Right, and so that's basically another thing also, right? So if you take activity like beekeeping, like you pointed out, it's an activity that is partly digital but partly real, right? It's the reputation comes from real examples of people doing expert things with bees and building hives and stuff like that. So that's how you tie that together is basically, I think, a strong a thing which kind of, in my mind so far, there's not that much clarity on. Because if I say, okay, I'm tying that to a arbitrary username, like say beekeeper123, there's nothing that stops me from going and then going back to the community as beekeeper, I don't know, 256, and creating another identity, and then at some point using the first one as kind of like a way to conduct, shenanigans.
Mm. Yes, but if there's a reputation, I mean, these are interesting considerations. If there's a reputation that Beekeeper123 is established, that is of value, and tarnishing that reputation has a cost, because it means that participant can't interact. Yes, so they'll be looking to maintain that reputation.
Absolutely. And so obviously then that goes down to the price thing of what is the cost of doing that, right? So if I basically say, okay, I want to use that particular identity and cultivate that identity and then use it to do some shenanigans worth a certain amount, that's worth that cost, right? And then that becomes kind of like a philosophical discussion about what is the value of something, of different things to different people. But yeah, I mean, that's something that we can go down. It's a winding path.
I think that is absolutely key to this, because as I mentioned, the contracts between various actors will tend to have greater and greater value attached to them over time as they build their reputations, because people through that reputation can trust that, for example, if someone is nominated or identified some pseudonymous identity is well identified as being a successful CEO of an insurance platform in the DeFi space, then DAOs will be willing to hire that person in and invest and entrust them with certain value. And that entity will be willing to fulfill their end of the bargain, because if they don't perform as an effective CEO, their reputation will be tarnished. So their value, the ability to extract value from that reputation will be diminished in the future. So you're quite right. And these are real and key aspects to all of the identities and the reputation, or more to the point, the reputations and the values that will accrue to that reputation over time.
Yeah, absolutely. I think this in fact, identity and is a very fascinating topic when it comes to decentralization and DAOs and the whole digital thing. So yeah, I mean, I agree. I'm looking forward to seeing what you guys are going to do next over there, because I think that is definitely one of those areas where the investment needs to be done.
Yes. Yeah, we're looking forward to it. It's a great game. We're enjoying this. We've got a great team. We're distributed all over the world, and it's like we're brothers and sisters, even though in the most part we have not met each other. But we have, at the end of meetings on our video calls, we'll grab a coffee and we'll talk about the family and our kids and our holidays and that kind of thing. So it's like we've known each other for years now.
Yeah, I hear you.
That's great. Brian, do you want to tell our audience a little bit about, where to find more information about Fringe Finance and how to get involved in your community?
Yes. Okay, so the single point to start with would be our website, fringe.fi. So that's FRINGE.FI. And I figure you may include this in the show notes. But there you will find links to our white paper, links to our Medium articles, and more of those come out over time. You'll find links to our social media, including Twitter and our Telegram community. Our Telegram community is quite active, and they keep us to task, and the appropriate announcements and visibility of what we're saying is available on Twitter. So they're good places to start. And anyone who holds any altcoins, definitely have a look at Fringe Finance, because there is an opportunity for you to not only sit and hold and passionately believe in the upside of your tokens, but you can now go out and deploy your assets to take out loans to deploy elsewhere in the DeFi ecosystem. And if, as a lender, you're interested in seeking better returns than what your US dollar holdings are achieving in a normal bank, yep, it's definitely a platform that is worthwhile looking into.
Well, this has been a really wonderful conversation, Brian. I want to thank you for your time. And I must say that you have quite bravely decided to go after a market, that others have shied away from. And I think it'll be really interesting to see how your company progresses over the coming years. And we would love to have you back a year or so from now and to check on how you're progressing. So once again, thanks for your time, and I wish you all the best.
My pleasure. Great to chat with you, gentlemen. And yeah, I look forward to in the future meeting you again and having another chat.
Cheers, Brian.
Okay, cheers. Bye.
Once again, that was Brian Pasfield from Fringe Finance. We hope that you enjoyed this episode. You can subscribe to this podcast on iTunes, Google Play, and Spotify. Also, you can learn more about us at bcdialogues.com. Thanks again for joining. See you next time.